Very good evening, everyone. This is Rajendran here, joining from Market Calls. And welcome everyone to Option Trading in Indian Markets. So this is a certification course, mini certification course from webinars. In today's session, we are going to talk about various things about volatility. In fact, a very good idea about volatility is what one can get by end of the session. I hope the audio and video quality is good enough to kickstart. All right, great. Thanks for the confirmation, Ankit, Arun, and everybody. So without any further delay, let's quickly kickstart with the session. A little bit about me. My name is Rajendran, and I've been trading this market since 2006 onwards. I've been a trading system designer, and now totally into full-time trading. Primarily, I trade index derivatives, and I also train traders primarily on topics like market profile, order flow, volume price analysis, and primarily on designing trading systems, particularly in NAMI broker and PineScript based trading systems. Now, today the topic is all about volatility. Right? Let's try to understand what exactly volatility is all about. So let me tell you, volatility, it explains how much a stock price is fluctuating. Now, how many of you watch volatility? Maybe just give me a quick idea about what kind of traders I'm trying to address. Like maybe what is your trading experience? How long you've been trading in this markets? Maybe 1 year. If you're trading in 1 year, you can say 1 year. If you are trading, okay, Ankit is saying like 5 years experience. How about others? Piyush is 1 year. Grigory is, Fernandez is like 1.5 years. And Yashwant 1 year. Anybody else? Okay, I assume most of them who have not participated. Ajit Kumar is like 1 year. Kasim is 1 year. Aniruddha is 1 year. All right, I guess it looks like most of the traders are from the 1 year kind of community. So let me tell you, there are two important things that we measure particularly from a trading point. It doesn't matter whether if you want to become a professional trader, you have to think not only from the directional angle, you also need to think from a very, very short-term perspective. So there are, when I'm looking into the market, first thing I'll be looking at is like, one is the trend, which side the market is trading on, and another side is like, what is the current volatility? So I'll be always having two views in the market. One is directional view. When I say directional view, I'll be having an idea about what the market is doing right now, whether trend is up or trend is down, or is the trend is going sideways. And when it comes to volatility, I always have a view about the volatility. Whether are we dealing with an high volatile markets? Is the volatility in the market is moderate? And is the volatility is low volatility? Now, how do we judge? How do we can say whether the markets are highly volatile, or moderately volatile, or low volatile? Maybe if you are watching Nifty on a daily basis, you know how much fluctuation it could make. One is by observing the market itself, but how using indicators or how using metrics, we can say whether the stock is highly volatile or the stock is moderately volatile. Let's take the example itself. How we can say, how we can categorize right now the current market situation, whether it is highly volatile or not. What are the ways that we can use? What are the indicators that we can use to measure volatility? And there is a small housekeeping here. It's kindly one should prefer using Chrome or Firefox, because the webinars platform suits for the browsers. It mostly compatible with browsers like Chrome and Firefox, so where you don't find much of audio quality issues. Maybe if in case if you are using different browsers, then maybe it's highly recommended to switch to the Chrome or Firefox browser. All right. Yeah. So these are the two important things. I always have a view at a very high level. Right? For that, what we do is like a small top-down analysis is what I try to do. In my top-down analysis, volatility plays a major role. Right, there are times some of the stocks, it could fluctuate in a very, very small manner. Some of the stocks, like, it will not hardly make any moves. Mostly, it will be fluctuating very small. But there are some certain stocks which could fluctuate in a very big manner from an intraday perspective. Right? So some big fluctuations. You could have noticed that. Not only in stocks, even in index like Nifty or Bank Nifty also, sometimes the markets will show small fluctuations. Sometimes you would have noticed that it will be frustrating, it will be dull, boring price action. And sometimes the intraday fluctuations will be very big. For example, last Friday, what happened? Nifty started at 16,400. It went all the way to 16,600. And then it crashed to 16,360 levels. And then it went again all the way up to 16,500 or again 600 levels. So it was, the volatility on that particular day was so crazy price action happened on that particular day. Now these kind of big fluctuations could result in kind of an heart pumping moves, whereas these kind of things are like dull, boring moves. These are dull and boring moves. Boring moves, most likely intraday traders are not going to like it. Even positional traders also sometimes they're not going to like it. But these kind of highly volatile markets, this is like high volatility markets, like kind of energetic markets, everyone will be there at the edge of the seat. It keeps right from the morning till the evening. It keeps the traders at the edge of the seat. So his audio quality is not great. Dinesh and Pratik is saying there is no audio, our voice is not clear. Can anybody could confirm once again? Yashwant is saying good audio. All right. Piyush is saying all clear. Ramesh is saying it's okay. Pradeep is saying good. Okay, most of the people are saying good. All right, then I'm continuing here. So maybe if you're facing any audio issues, kindly exit and then reconnect back again. All right. So what we learned that is like it's always good to have a directional view and also volatility view. As I said, I do have always both the views about it. For example, maybe what I'll do is like for getting a directional view, it's a high level view in general what the market is doing. Right? We are not going to take any signals from that before starting any day or any week. Mostly, whenever I'm starting any fresh week, I always do top-down analysis. And once in a while, once every 3 days, I do top-down analysis to ensure that I observe the general trend. What is the general trend is doing? I'll always start with quarterly, monthly, and then I'll narrow down to weekly and daily time frame. I also have a fair idea about what are the upcoming macroeconomic events coming in. Let's say any inflation numbers are coming in, or any GDP numbers are coming in, or any major announcement like Fed announcements or RBI policy announcement. Right? Any upcoming economic events are coming in. Or if it is earning announcement, is there any major announcement today? Like Infosys results are getting announced, or TCS announcement results are getting announced, or Reliance results are getting announced. Any such big company announcement is there or not? So I do have a regular check on that. And of course, what is the current market volatility? All these things we approach the market at a very higher level. So what is the primary benefit here is like your risk management skills will better the moment if you start focusing on the volatility. Particularly when you start observing the price action with volatility, your risk management skills will get better. And of course, another add-on benefit is like you will get a bias-free approach. Every time you will have an opportunity to take a fresh decisions, so that you will not be congested by the very old thought of like like biased approach. Sometimes people get biased for every wrong reasons. Because of some TV analyst said that the market will be bearish, because FIs are selling huge amount of money, or you might be seeing that one information which you thought it is bearish and you're not able to control it, and you keep on taking a continuously long, or you keep on shorting the markets. So that will not allow you to be flexible as a trader. Now, one of the factors as a trader is that you have to be as flexible as possible. Means today I'm going long, tomorrow I should have the guts to take a short. And once again, I have to take the guts to take a long if markets are giving me a long opportunity. And that is very difficult as a trader, you know that. Because the moment one or two trades, maybe it looks easy. I can go long and then I see a short opportunity, again I can short. But when you are going to do this continuously, it's going to be a challenging thing. At times, when there is a whole economy is at crisis, you have to take a long decision. Or when there is a crazy greediness is going on, every indicators are showing positive, maybe you have to go and short the markets, and that is totally crazy at times. And it's as I said, like it's very difficult to nail it on a daily basis. But if you want to nail it, we need to have a bias-free approach. We need to drive with the data-based trading decisions. Now, that is where the top-down analysis will help you out in narrowing down the focus. As I said, I start with quarterly. So let me go to the charts. You can take any of the charts, like a chart from AmiBroker or TradingView. Of course, TradingView is free. You can try it out. So in my case, I'm using AmiBroker. I've been an AmiBroker user for more than a decade now. So I'll start with quarterly. Okay. So quarterly, if I'm going to see here, last 4 quarters, market had absolutely done nothing. So that means investors are at not making any money for the last almost for a year or so. Literally, investors enjoyed the markets since post March 2020 till the start of the 2021. But post 2021, that is like the market has been literally going sideways. Not of course sideways, but sideways to down is what we can say. Nothing much really happening for the investors per se. And then if I go to the monthly time frame, this is the monthly time frame here. I'm seeing something very interesting about the price action and also about the volume activity. You can see that the March 2020, here is March 2020, that when the crisis, COVID crisis was getting extreme, when the entire nation goes for a lockdown, the volume was extraordinarily high. And that is the same thing which is happening right now also. Right now also, the volume is extraordinarily getting high, but not for current month, but for the last 5 months continuously, which is means starting from February onwards. You know why from February onwards? Because February only we had that Ukraine-Russian war tension started, right? The Ukraine-Russian war started, and then ever since then, the volume has been at the highest. When the volume is at the highest, that means what? That doesn't mean like more FIs are selling that. Yes, that is one another way it is true. But this is Nifty futures, right? In Nifty futures, more activity is happening, means more and more traders are coming and participating. Earlier, very few people they have participated. That is why it resulted in lesser volume. Now more people are participating because market are fluctuating even more. Bigger trading opportunities are there. Whenever the bigger trading opportunities are there, the candles will be bigger, and that will result in highly volatile markets. Okay, so that's one of the primary reasons. You could see that month on month. You know, what is the average fluctuation that we see in Nifty futures? Anybody? Or how we can measure it? What is the average fluctuation that we could see? Just give me a second, I'll inform them. Consider using Chrome or Firefox. Okay, what I was talking about volatility, right? So the volatility, more the people are trading, higher the volatility it is. So that is the easiest way to measure volatility. So let's try to understand what is the current volatility which is happening on a different scale. Okay, if I'm going to look into the monthly charts, so here is a monthly time frame. What I can do here is I can go and write a simple formula. Like it's a very simple formula. I'm going to plot a range. I'm going to do what? I'm going to plot a range, which is nothing but a high minus low for the month. I call it a range. Put in a color black. The file histogram. All right. I'll save it and then I'll apply it. A semicolon. Or maybe I'll keep it red so that it will be color contrasting to the volumes. And then I'll apply it. I'll just simply apply it. Now what I could see here is, look at that. This is a monthly range. You know, right, March 2020 had a very biggest monthly range, almost a nifty. I mean, that quarter, it's a quarterly range though. Let's go back to monthly range. If I want to look into the monthly range, so you can see that continuously last 6 months, so last 6, 7, 8 months, Nifty on an average making 1,500 points. 1,500 points is what continuously on an average is making. Like this is like in November 2021, 1,559. You can see the numbers over here. 1,559. This is in November. And for dates, you can see it over here. Which month exactly? You can see the dates over here. Now, if I move my cursor to the next candle and I select it, you can see that it is like 1,200 during December and approximately 1,500 and 1,579 points and approximately 1,879 points, 1,330 points, 1,404 points, 1,587 points. Right? This is the average fluctuation that we are seeing on a weekly basis. Is that a high volatility? If you ask me, yes, it is. Historically, comparing to the past, now the volatility has been increased. So you can see that earlier, during March 2017, the volatility range was very different. And see that even we had seen like entire month, I'm talking about entire month, we had seen like 360 point fluctuation. And 264, 579, like now it is happening on a weekly basis. Whatever happened back in 2017, which is like 5 years back, look at that 2018, average fluctuation was like 700, 800 points. In some cases, we had seen 1,000 points, which is like because of some sort of tension, like trade war tension was there. Because of that, Nifty went like 1,000 points. Now we are casually doing. Why? Because now Nifty has been, earlier Nifty was like 10,000. Now it is like 15,000, like 15,000 or 18,000 is what. So the price has been increasing. When the price is increasing, the size of the fluctuation is also one another way it is increasing. Right. So, but in a short term, if you're looking into that, what is the average fluctuation which is happening? Definitely, I should need to know about that. Monthly, what is the average fluctuation? Monthly, I know that 1,500 is the reasonable fluctuation to anticipate. Right. However, if I go to weekly, definitely a weekly fluctuation, everybody should need to know about it because most of the traders in options these days, they trade weekly options. So you need to have a fair idea about how much on a weekly basis Nifty is fluctuating. So though this is not a better measure, but it gives a perspective what was the average fluctuation which happened last couple of weeks. So last couple of weeks, you can see that 791, 684, 623, 512. I could say like roughly anywhere between 500 to 700 points is what Nifty is fluctuating on a week-on-week basis. But there is a measure to do that. What we can do is like we can take an average value, how much it is fluctuating. That average value is what we call as the average true range or ATR charts. One can go and use ATR charts. So here I'm just using an ATR charts of period. I'm going to use a short period over here. Last 5-week average is what I'm just taking. So we get a perspective what is happening in the last 5-week ATR. If the ATR value is cooling down, that means what? we are seeing very thin fluctuation, very small fluctuations. Right now, what is the average ATR? I mean, average fluctuation. The average fluctuation, what we are seeing is 427 points. That means on a week-on-week basis, roughly around 500 to 600 points from the high to the low, it is making up. What does that mean? That means maybe a market can go, that there are, let's try to understand this, the 627 points, what could be exactly that means? Or what is the possible in upcoming days, what we can anticipate? A rough idea. It's not exact prediction though, but it's a rough idea which has a very high odds. Let me try to explain this volatility. So how do we can see this volatility? Okay, let's try to think a little bit about it. Assume that I'm going to give some scenarios about it. I'm going to give scenarios about weekly volatility. Weekly volatility. Okay. So imagine that currently Nifty is at 15,700. Now, what market can do here is like straight away from 15,000 next week, let's say Nifty opens exactly at 15,700 spot, and it can go straight away up from here. Assume that market goes in a very straight line. On a daily basis, Nifty goes up. Maximum it can go from the 15,700. That is like, let's say Monday, market opens at 15,700. And right from that, straight away, market keeps going up. So that means on an average, we could see 623 is ATR, right? ATR, current ATR 5 is how much? ATR 5 is 623. That means we can have a fair idea like Nifty could be on an average, maybe in a near term also, Nifty very close to 623, maybe something like somewhere around 500 to 650 point range, we can expect a fluctuation. Why I'm just taking a lower number? Because volatility is slowing down. If you could see the ATR charts, the ATR value is slowing down compared to the previous week. So volatility is slowing down. So I also keep my expectations lower. Next week, my expectation will be like 500 to 650 points. That means if I assume that 550 will be the fluctuation. So that means if Nifty is going to start at 15,700, if I'm so bullish in the markets, assume that I'm totally bullish about the markets, then maximum I can expect a target of how much? 16,250, right? 16,250. But the question here is, will the market ever move in a straight line? What do you think? Does the market move in a straight line all the times? Of course, no, right? Yes, sometimes market moves. Sometimes when the markets are showing extreme bullishness or extreme bearishness, market will take a one-sided opinion, right? So there are times maybe if you are thinking like market might go sideways, maybe how I can think about it, like let's say market on Nifty Monday opens up 15,800, let's say 100 points gap up. 100 points gap up from the Friday closing, and it goes like 250 points up, 250 points up. So that means it can go to like 16,050 kind of levels, and it could fall down from there. It could even fall down 550 points also. So it means from there 550 points in the sense it can even go to 15,500, and it could again come back and settle down around 15,700 levels. It's something like this also, this kind of expectation also one could have in the markets. So we need to figure out at least some sort of idea what we should have, what could fluctuate. This will narrow down your focus to a greater extent. If it is not a straight move, then what kind of sideways move we can anticipate? Because that is what is going to happen 65% of the time. 65% of the time. So now these kind of trending moves can happen 20% of the time. Trending move either up or down, it can happen 20% of the time. Sometimes what can happen, it can go up to this that straight 500, 600 points move it can done, and then it could bend down from there a little. That is also possible. Or it can go down 600 points straight away and then it could pull back. That is also possible, right? So most of the time what we can expect is like kind of a sideways price action, because there is no free money in the markets. I strongly believe that there is no free money in the markets. If at all free money, right, market keeps on going in one direction and traders happily make money out of it. Is that the thing which is happening in the markets? Of course, no, right? So having a strong idea about volatility will help you down to focus, particularly beginners, the beginner level trader or 1 year trader. Because most of the people are having a very weird expectation. Nifty will go to 14,000. Nifty will go to 8,000. Nifty will go to 20,000. They are having very weird thinking about the markets. They have a pretty wrong idea about volatility. See, having a view about volatility, definitely it will improve your thinking. Okay, if market itself gonna move only 500, 600 points next week, then how I should prepare? That is the next best question that you can ask. Am I right or not? If market itself gonna fluctuate 500, 600 points, then where it could move, why it could move, how I can defend the markets, how I can play the game better. That is the right question as a trader you have to ask. And then comes the daily volatility. So what I'll do, I'll again go back to AMI broker. I do look into the daily volatility just to get an idea. This is daily volatility is very much important, because if you are an intraday trader, if you're a positional trader, you should have a very good idea about weekly volatility, and of course a mild idea about monthly volatility, because monthly volatility is very difficult to estimate. More or less right now we are at 1,500 points. Maybe tomorrow we can even go to 1,200 points, 1,000 points also. Depends upon where Nifty is there, and depends upon where Nifty price action is happening. However, having a daily and weekly volatility is a must if you are a routine trader in the markets, or whenever you are trying to take a short-term view in the markets. Before trading your setups, let your setups be anything. Let it be an Fibonacci-based setups or Renko-based strategy, or let it be only an option seller you are, or you are only an option buyer you are. It doesn't matter. But having a volatility view will keep you in reality, so that you will not be gambling with options trading. You will not be blindly betting in the money markets. At least you will try to think what strategy I should adopt in this kind of market environment. In a highly volatile markets, when the markets are fluctuating very bigger, how I have to take a trading decision. In a low volatile markets, how I can think or what kind of strategy I should play. Because different times, right, we have to play different approach towards the markets. Like a sportsman, you think about a sportsman, let it be a cricket, or let it be tennis, or let it be badminton, or let it be any sports game. If you would have seen any international sportsman, what you would have seen is like variation in their games. They don't show the same games over and over again. Of course, they do have signature moves, like Dhoni's helicopter shot. Right, so every great sportsman, they reveal their signature shot once in a while, but not on a daily basis, not on every continuous games. Right? So same way, a great trader has to show their variations in different markets. The market is going to be different. Market which we've seen in 2017, 2018 are very calm markets. But in 2020, we had seen in one of the biggest volatile markets. The same level of volatility, same level of participation, right now it is happening. With same amount of fluctuation. On a daily basis, Nifty is fluctuating 200 to 300, 400 points, sometimes even 500 points also. Crazy fluctuations for no reasons. Earlier, at least we have something we have, but now probably the macro thing is like probably Fed is restricting the free money. So people are getting out of the FIs are getting out, and markets are getting volatile because markets are fluctuating on a daily basis. DIs are buying on one side FIs are selling. So crazy fluctuations are happening in the markets. It doesn't matter what happened, is like more people are now coming and engaging. When more people come and engage, what will happen? Volatility will happen. Bigger fluctuations will happen. So ATR is one way we measure it. So what is the weekly ATR? Weekly ATR is 627. If I go to daily, I right click, I'll go to parameters. I'll change it to 10 period ATR. So 10 period ATR, not on the weekly, but on the daily. I'll go to daily time frame. Daily time frame. Yeah. So this is daily time frame. You can see that what the volatility is doing. Volatility is trying to already from here, volatility started cooling off. When the volatility started cooling off, what does it mean? Like more and more calm markets is what we are experiencing. Right now, there was a mild improvement in the volatility. Again, market started slightly fluctuating. Right now, the current volatility is 266. So what does that mean? On an average, we can see any fluctuation between 200 to 300 points of fluctuation on an average. From an intraday perspective, I'm talking about that. Price opens and then high to low fluctuation could be like minimum 200 to 250 or 300 points. And that is the average. So this is only one day where the Fed announcement was there. It's a news-based. So market fluctuated like 537 point range. You could see the range here. Intraday ranges. And then you could see like 216, 181, 281, 200, 269, 137. So the volatility slowly started coming down. If the volatility started coming down, I will be having an expectation down below 266 only. I'll be having an expectation. Maybe I'll be having an 200 to 250 point is the average expectation I'll be having in my mind when I am thinking to trade from an intraday perspective. Okay, so when you're thinking like that, what will happen is like, you will be thinking about scenarios. What if this is going to happen? Or what if that is going to happen? Earlier, we'll be having only one thing, either bullish or bearish. Anyways, at the end of the day, when you're start trading, you definitely need to have a view, either bullish or bearish, or you may want to approach the market in a neutral way, like directional neutral. Either you are not bullish and either you are not bearish. You want to manage the fluctuations only. But however, even if you want to manage the fluctuation in the market also, one should have a pretty good idea about volatility. Then only the setup matters, then only trading the signals matters. All right, first thing is like have a proper idea. Let it be Nifty or let it be Bank Nifty or let it be any other stock. You need to have a proper idea about volatility. Okay, so this small exercise, what we had done right now, is what the routine procedure. I do it on a daily basis. I do it on a weekly basis just to have a hang about what is the current trend. If I look into the current trend in the markets, let me go and show you the current trend in the market. I'll go back to the PPT here. Monthly trend is right now, immediate trend. I focus on the immediate trend. So last 3 months it is down. But at the same time, I'm also seeing that the price is still circling within that band of 15,500 to 15,000, 18,000 levels. Roughly 2,500 point band it is. The band got a little bit broken, but again, prices got back into the band. So what does that mean? Even though price is going sideways, it's been going sideways for almost 12 months. Last 12 months, price is still into the sideways. But what is the immediate trend? Immediate trend is like last 3 months, price is going down. So this will help me to narrow down my focus. What level I should focus? Okay, immediately price is down. Even if it is going up also, let's say next month, if I'm thinking about market may go up, maybe my maximum upside target will be like, I would like to target most likely the recent levels. Maximum, I'm talking about. Next entire month, that is July month, if it is starting. And if I am thinking that if I am going to be bullish, I will try to stick to the reality. I know what is the reality. Reality is like July price going to 18,000 is very rare. Market can do that. I'm not saying like market will not do that. And I'm not here to bet about like market will go to 18,000 or market will go to 9,000 or 12,000. Once in a lifetime or once in a decade, that kind of price action can happen. Like this kind of price action. This is like once in a decade kind of price action. But I'm a full-time trader. I cannot go and bet like this month will be like similar to March 2020 month. Many people have done such kind of bettings after March 2020 happened, right? Many people, they try to bet like Nifty will go to 6,000, Nifty will go to 5,000, Nifty will go to when price started rising and people started yelling like Nifty will come to 10,000 and Nifty will go to 9,000 from there. Price started rising and Nifty started go to 12,000. None of them happened. None of them happened. And none of them are going to happen. But it do happen. Once in a while, it do happen. We never know when. And for that lifelong, right, we can't keep on betting on that kind of extreme bullishness or extreme bearishness. Let me tell you, that will always get you into a gambling mentality. It will make you to bet on some weird strike prices. All right, so trying to stick to the immediate trend is more important. At a monthly scale, what I can look into is like long-term trend, what the long-term trend is trying to do. So it's trending down. So then I look into the weekly. Weekly also last 4 weeks. Immediately, if I look into the last 4 weeks, price is still going down only. Even previous week high itself still not taken out. Okay, we call this like kind of one time frame. One time framing is the word. Immediately, weekly trend is also down for the last 4 weeks. And what I can see from the weekly charts also, volume is at the highest. Notice that volume has been at the highest since February onwards. Weekly volume is also at the highest. Similar to like at par with when there was a crazy lockdown period has been there. What kind of volume we had seen during March and February, similar volume we are seeing now also in Nifty. And then finally, I'll move to the daily trend. For me, daily trend is more important than the weekly and monthly trend because I'm a short-term trader. I trade in the markets. The maximum for my holding period will be maximum for 4 or 5 trading sessions because I trade mostly weekly options. Sometimes I do trade next week options or monthly contracts, max to max. So I'm a short-term trader in the market. Maximum my holding is going to be anywhere between 3 to 7 trading sessions if I'm going to take positional. And sometimes it's going to be mostly intraday. If I don't like positional, I even switch to intraday. Because there are times market will frustrate when the volatility is going to be very low. So you have to take very fast trades. Sometimes we have to take a very slow decisions. You know that target is slightly bigger, but you have to deal with that. It is going beyond your volatility range. So sometimes only in those cases, maybe we'll look for 2 weeks of view. The more shorter the view you are going to have, the more immediate trend is what one have to focus. Let me repeat the word. The more shorter view, let's say if you are worried about what will happen to the Nifty next 2 days or next 5 days or this expiry, then more you have to pay immediate attention. That means my attention will be more on the daily trend than on the weekly and the monthly trend. Yes, I do have a perspective about what is happening at the monthly scale, but that is only a perspective. Weekly is also only a perspective. I know that last 4 weeks it's going down, but my focus will be more on the daily trend because daily trend keeps on changing very frequently. Last couple of days it was going down, and until then last week it totally changed. It started keep going up. Last 5 trading sessions, Nifty has been on the upper side. There is a small uptrend we are seeing from 15,300 levels. It went to 15,700 kind of levels. Like last 5 days, there was some 400 points of move. I mean, 400, 500 points kind of move is what we had seen. So my focus will be on the immediate attention. So when the immediate trend is changing positive, so how I should think? Or if it is turning down, or I'll be asking the question, what are the chances that it could turn down from here? Is my indicator saying anything? Or is the price saying anything? Or is the volume saying anything? Are the tools that like what I use, like market profile kind of tools, does it say anything that what are the chances of reversal? If it is a reversal, then how much down it can go? Is it within the volatility range? In that case, what strategy I should use? What kind of directional approach I should use? If I'm not happy about directional strategy, I will primarily get into an intraday mode. That is what primarily I do most of the times. But always having a volatile view will help you out. And doing the top-down analysis will help you to stick to the reality, what is possible. what kind of environment right now we are in. You know that one side, the market's also slowing down the volatility. Volatility off late, last 5 trading sessions, volatility started pulling down. When volatility started pulling down, probably volume also will start pulling down. If you are experiencing lower and lower volume, right? So that is an indication that markets are calming down its nerves. So in that case, you may have to take a different approach in the markets. Remember, volatility will not tell you the direction. There are times market goes down. Most of the time, market goes down with high volatility. There are times market can go down with low volatility also. It's not like always only with the high volatility market has to go down. And initially, this particular phase, it was a very tricky phase because this phase, initially it started with the low volatility from up to here. Then only volatility started picking up from here. Initially, a very slow and steady correction. You can see that the candles has been very slow. But every day, Nifty used to slide very, very small points, 40 points, 50 points. Slowly, it was going down. Slowly, it was going down. Slowly, it was trading down over here. Until then, suddenly, the volatility started erupting. So, Nifty slided 1,000 points. Then only volatility itself started showing on the downside. That is how the price action was. It is so not necessarily a high volatility has to show up. However, these are very clear-cut phases. When this play started, VIX volatility index started expanding. IV started expanding right from here onwards. Here also IV started expanding. This place also IV started, volatility started increasing. So right from that particular phase onwards, IV started increasing. But here, this is the only phase, this particular phase during April and May month, which was quite tricky because every day price used to rally. First half and second half, they will drop down. Market closes negative. And the next day, they open gap up and they go down and they pull back. And once again, they drop down. So it's so crazy, confusing moves. Every day, market goes up, or even if it goes down, also they will rise and then they will drop down. That is the day. Every single day, almost they have done this. From this phase to almost mid of the March phase. Very difficult phase it is because market are slowly going down. And then later on, it picked up speed. And very rarely we had seen some big gap downs kind of openings. Rest of the places, it was kind of unpredictable moves most of the times. But I can tell you one thing. Recently, Nifty had broken the lows. So I know that most of the people will be bearish. It's very difficult to control the nerves at times because you will be always watching levels. We are humans. So we'll be watching the swings. This swing has been broken. That swing has been broken. So we'll be anticipating, okay, if this swing is going to get broken, maybe 1,000 points fall will be there. That's the kind of instant decision we will be coming up with. But we'll never know how it will come. And the reality is like what we think, what our brain thinks. What our brain thinks is like, we are pretty much fearful. So how much ever we are fearful, that is the thinking that we'll be having. Okay, Nifty will definitely crash 2,000 points this month. That is how we immediately think of with that kind of mindset. But repeatedly on a week-on-week basis, despite how much ever we are thinking, the markets is doing what it is supposed to do, right? So majority of the time, as a trader, what you have to do is like what the markets are doing, we also learn to do the same thing. Very, very close to close, we'll try to follow. The moment we are deviating away from the markets, that means we are somewhere going wrong. Maybe we need a reanalysis in our, we have to redo our approach. We have to change our trading approach. That is what it is primarily required. Okay, let's have a quick idea about what affects the option premium. There are 6 important topics over here which could affect the option premium. One is underlying spot price. Spot price, definitely change in spot price obviously attracts the change in option premium. Strike price can also impact the option premium. For example, far away strike price will have less premium, and the immediate strike price will be like at the money or in the money will have huge premium. Out of the money options will have less premium. An expiration date is also going to impact the option premium. more the time for the expiry, more the premium it is. Lesser the time for the expiry, lesser the premium it is. And when it comes to Indian market, we don't include interest rates and dividends. So that means what? We keep interest rate as 0, dividend as 0. We consider that as negligible. And even from the Black-Scholes equation, we remove the interest rate part and dividend part. And next comes implied volatility. As I said, implied volatility is most important measure in the markets. So how we can see implied volatility? You can use tools like Opstra and you can see the implied volatility. Let me show you how you can see the implied volatility. You can go to Opstra. Last time also we talked about Opstra, right? You can go to options. You can go to the strategy builder. Now under the strategy builder, you can see the implied volatility. IV for the option IV is like 23. Now, how this IV is derived, if you ask me, IV is derived from the Black-Scholes formula. It's a slightly complex formula. I'm not going to go deeper into that. But the IVs are calculated mostly based on the at-the-money options. Maybe if I go to the option chain, right now expiry is going to near. So I don't think there'll be, the current month at-the-money options is like, you can see that 21 and 21. But however, they are not taking from the current month because current month is nearing the expiry. So most likely they'll be going to the next month options. So maybe from the next month options, they will be mostly getting into the IVs from here. Either from next month or from the subsequent far away month, they'll be mostly taking primarily at the money options like 20 is the IVs. So the next month contract is what they will be primarily prefer to use to take the IV values. At the money options, so maybe an average of at the money call and at the money put is what primarily most of the traders they'll be using. And most likely, some people they go for next week contract. Next week contract. What is the next week contract? Next week contract is also more or less around 720 only. So 20 is on average, 20 is the average IV levels that we are seeing over here. Okay, 20, 21. So keeping that in mind, let's try to understand what is implied volatility. Probably ATR, you know that is the volatility. ATR which measures the volatility. Intraday range, that is also volatility. Intra-week range, that is also volatility. But implied volatility is different from ATR because it is calculated from the option prices. From the option prices, using a mathematical model called Black-Scholes, implied volatility is derived. And this is a basic primary requirement for calculating the option Greeks. If you want to calculate option Greeks, implied volatility is very much required. So implied volatility talks about anticipated volatility in the future, like how much market can fluctuate in the future. Whereas the ATR talks about what? Current market volatility. It talks about last 4 weeks or last 5 weeks, how the market fluctuated. What is the average fluctuation for the last 4 or 5 weeks? That is what ATR is all about. We have seen ATR, right? Let me go to the chart. From the ATR, we had seen that what? This is the average fluctuation. For the last couple of days, on an average, markets are right now fluctuating 266 points on an average. Since the last five days of average, or last 10 days of average fluctuation, here it is. This is an volatility measure based on the past data, or we call it as a realized volatility. Whereas implied volatility talks about future. When I say future, what is the expected volatility? What is the upcoming volatility for the next 30 days? Or what is the upcoming volatility for the next 1 year? That is implied volatility, and that is calculated from the option prices. There's a difference is there. ATR is calculated from the raw open, high, low close of the candle. Whereas implied volatility is calculated from the option price itself. Generally, at the money options are generally used to calculate the implied volatility. On a daily basis, what is at the money call and at the money put? They take an average out of it, and that is what they consider as an IV for that particular stock or particular index. So if the higher IV, higher implied volatility, that means more option premium. When implied volatility is more, typically More implied volatility means there is more greed or more fear is there in the markets. People are expecting big fluctuations in the markets. Remember the term, people are expecting very big fluctuations in the markets. Will it materialize or not? That we don't know. Not necessarily if the implied volatility is high, not necessarily historical volatility. The ATR is also not necessarily has to be high. Sometimes there could be an RB announcement will be there. People will be having high expectations in the markets, but then reality market will go sideways. So that is the kind of day we could have even seen. Couple of places, market will have huge anticipation, but out of that, nothing would have been happened. So the volatility will also slow down from there. But there are places like we'll be seeing high volatility when there is a markets are in a crisis period. When the markets are in a crisis period, option sellers, they tend to charge a huge premium because you know that, right? Whenever there is a huge crisis is there, option sellers are the one who takes the maximum risk. In the previous part 1 of the session itself, we already discussed it. If you haven't seen the part 1 session, just go back and go to the Feminaz platform and look into the what we spoken about the option sellers. So option sellers, no matter what, they will always take risk. Right. So they are the one who decide the premium. So if they know that there is going to be a crisis kind of period, they will start charging higher premium. And the participant, the buyer also willing to pay a higher premium because there is going to be a big fluctuation on the hope that they will be making some money out of it. And in a lower IVs, generally market will happen in a very calm environment. Market will be calm, trading calm, not much of a bad news, or of course not huge bad news as such. Maybe always bad news will be there in the markets, always. You could have been seen that everywhere, every time there'll be always a bad news. March 2020, we had seen lockdown, and then we had seen lockdown 1, 2, 3, 4, all the versions of lockdown we had seen. We had seen the phases of Delta virus, Omicron 5 virus, and despite that, market went up. And then we had seen tensions, which is coming from like China. Anytime it could attack Vietnam, but still it haven't happened yet. And then a lot of tensions happened around global markets. Sometime back in 2018, we had seen trade war tensions, right? And then demonetization. Before that, NPA crisis, right? Brexit kind of crisis. So a lot of crises the market had seen. Almost at some point in time, there will be always crisis. Right now, what is a crisis? Crisis is like inflation is rising. Inflation fears are there. Fed is increasing the rates. So markets are falling. And Fed is limiting the free money supply. So that kind of fear is always there. The question is, what is the intensity of the fear? Bigger the intensity of the fear, yes, market might be crashing. If moderate intensity of the fear, market generally take it calmly. You don't find it in the implied volatility much. Maybe I'll show you the implied volatility of Nifty chart. This is the implied volatility of the Nifty chart over here. You can see that the implied volatility is ramping up because people are having huge expectations, right? So almost it went like something like 87%, somewhere around that level is what the implied volatility went. Obviously, IV is a number which is represented in terms of percentage terms. Okay, so if the IVs are rising, that means these are the places option premium will go crazy. Right now, you can see that fear is there, but it's not at that expected phase. Fear is there. As I said, fear is always there in the markets. But the question is, what is the intensity of the fear? The intensity of the fear was at the peak when there was a COVID crisis. When there is a total uncertainty. This kind of fear can happen when there is a total uncertainty is there in the markets. Right now, are we seeing an uncertainty? Of course not. Fear is there, but it is not uncertainty. It is not extreme uncertainty. But what happened in March 2020 was like extreme uncertainty. Right. So probably if you could see any stock with extreme negative news, right now, you know that RBL Bank. You know RBL Bank? You know what news is happening in RBL Bank? I haven't tracked the news, but I'm sure that there is some bad news is going on. But I'm sure you guys track the stock news, right? Some people, they know why RBL is crashing. Some people are really curious about what is happening in RBL. The last couple of days, what has happened? RBL has been crashing down. Even one of the day, right? RBL is down by how many percent? 16, 22%. Right? So what is happening here? 22% is the RBL got crashed. Maybe some negative news would have been hit the markets. That is why the stock would have been went down. When such kind of news is coming in, what will happen is like sometimes the volatility goes to the peak. So if I go to the implied volatility, let me show you the RBL implied volatility. I'll go to the IV charts. From the IV charts, I'll go and select RBL Bank. Of course, this is going to show me a lot of other metrics as well. I'm going to turn it off. I'm going to turn off the historical volatility, IV and RV spreads. And I'm going to pick up only the historical volatility for the last couple of. Now we can see that slowly the IVs are increasing. IVs are increasing because maybe more and more bad news, and because of that stock price is collapsing. That is the kind of thing which is happening over here. Like IVs are implied volatility, normal implied volatility. This is normal implied volatility. 32, 33, 34 is the implied volatility. And differs from stock to stock, the implied volatility will differ. Right now, what is implied volatility? 30, 33 is the normal volatility. Last 1 year, 50 and 40, 50% is the normal volatility. Now, the volatility is increasing to how much? Like something like 88 or 88 or 70, 88 is the range. It's fluctuating. Now, what is this name? What is this number? How do I interpret this number? So that is what I'm going to talk about here. So talking about implied volatility, right? So what causes implied volatility to rise this? It can rise because of so much of greed in the markets, or it can also rise mostly because of a fear in the markets. As I said, fear is always there in the market, but what is the intensity of the fear? Sometimes there will be a special theme will be always going on in the markets. For example, geopolitical tensions. Right now, we've been facing Russia-Ukraine tension. That tension was at the extreme during February and March because Russia was doing this, Ukraine was doing this. Maybe this could lead to a world war. Well, a lot of tensions surrounding Russian war tension happened. Of course, war has been always happening in the world. At some part of the world, always war is happening. But a lot of media attention happened because it's not only about Russia and Ukraine, it's also about NATO and then US market, US involved in that. So almost it was under limelight, under media for every wrong reason. So when it increased the fear, that creates a lot of uncertainty. And that uncertainty is what that causes IV to rise crazily. And then sometime back, we had that US-China trade wars back in 2018. That was a theme. Entire year was the trade wars between US and China was the under limelight. And then 2017, it was like UK, European Union, Brexit. Like Britain was exiting from the European Union. And then 2017, we also have North Korean missile tension. Like every other day, they'll be launching some ICBM missiles for testing purpose. And the terror attacks, the world had seen a large number of terror attacks. And then Hong Kong unrest in between. So a lot of geopolitical tensions, at times they spook up the markets. And local political factors, sometimes state elections, even for state elections, IVs used to go up earlier. Like sometime back, Gujarat elections, IVs went up. And then the Maharashtra elections, North, East elections, Karnataka elections, every other cases, market even reacts to those state elections as well. And central elections, people will have crazy expectations. IV will go crazy, like implied volatility will go crazy, like 30, 40 kind of percentage. When that is going to be a central election, like 2014, 2019, both the places, IV was rising because people had expectations. And then sudden surprise news elements like demonetization, bank recapitalization, corporate tax cuts. Now all these are surprise announcements. When there is a sudden surprise announcement is there, when no people was anticipating, suddenly there was a crazy news is happening, and that goes the VIX will suddenly start rising and IVs will start rising because again that could bring more greed or more fear in the system again. Or sometimes RBI or Fed policy announcement when there is so much of anticipation from our central banks to do something about the economy, right? So when there is a huge expectation, there also IVs are likely to go increase. Sometime there will be budget announcements and then earning announcement from the companies, or there's going to be merger, demerger, or even sometimes extreme negative news flow on stocks. That is what it is right now. It's happening on RBL. Some negative news is floating out, and that is impacting the stocks, and that is making uncertainty in that stock. So IVs tend to increase, and that in turn it increases the option premium as well. All right, so we know that what is implied volatility. Now, how to interpret that numbers? So first thing first, before understanding the implied volatility numbers, right? So you need to have some fair idea about normal distribution. Maybe you would have studied in your high school mathematics. This is like normal distribution, right? Of course, it is not normal. Let's say, try to draw a bell curve shaped distribution. You know, right? The center part is what we call as a mean. We call it as a mean. This normal distribution is more to do with something called probability. Probability density functions or something like that. I'm not going to go too much into the math, but I'll tell you, it's like 1% standard deviation, plus or minus 1 standard deviation. The center point is what? The center point is a mean, or we call it as a 0. And we'll be having plus 1 standard deviation and minus 1 standard deviation. If I shade this zone will cover how many percentage? Anybody? Anybody able to recollect from your high school studies, high school memories? What is the percentage? 66? Of course not. It's 60, approximately 69 point. Approximately 68%. 68 point something. Okay, so it's a rough estimate that the plus or minus 1 standard deviation contributes to 68% probability, the chances of occurring. That is what exactly implied volatility also says. The plus or minus 1 standard deviation move, it talks about that. So this implied volatility, let's say if the implied volatility of the Nifty is like 20%, assume that implied volatility is 20%. So here is the formula here to predict the 1 standard deviation move. It's nothing but underlying spot price into implied volatility into square root of days to expiry divided by 365. So if, assume that there are only 4 more days to expiry and IVs are at 20%. That means what? Nifty spot is 15,700, rough estimate. 0.2 means 20 divided by 100 is 0.2, and square root of 4 divided by 365. It brings to the range that Nifty could fluctuate 328 points plus or minus. Means from the current level, what's the current level? Nifty is like Nifty is how much? Nifty is like 15,700. So my upper level is 15,700 plus 328. So which means how much? 15,000, not 15,000, but 16,000. 16,028. And likewise, lower level, 15,700 minus 328. So that brings how much? So that is like 15,372. Is it like that? Of course, looks like 15,372. Okay, so that means there is a 68% chance, approximately, chance of Nifty to fluctuate between 15,372 to 16,028. Okay, so this is the current information that I can get it from that. There is a 68% chance Nifty is likely to trade in this range, maybe for the next week. Is that true if you ask me? Of course not, because IV also keeps on changing on a daily basis. Implied volatility changes on a daily basis, so the number could be slightly varying on a daily basis also. Okay, but this is a rough estimate. This is only 68% probability. There is a chance that the market could go beyond 68% probability also sometimes. Right? There is a 32% chance that price can go and break either the lower side or upper side also. But what statistically, it is proven also that Nifty had a very high chance of fluctuating plus or minus 328 points. That is like between plus 1 standard deviation and minus 1 standard deviation. That range is very, very high. Of course, in Opstra also you can see that range. Maybe you don't need to calculate. You don't need to calculate on every stock. In the payoff graph itself, let's say I'll go to the Opstra and I'll show you where you can see. If I go to, let's say, I'll go to strategy builder. And from here, I'll go and sell a straddle. I'll go and sell a straddle. Or let be any payoff graph for that sake. It doesn't matter. You'll be seeing the plus 1 standard deviation and minus 1 standard deviation. Currently, wherever Nifty is, from there, what is the minus 1 standard deviation range? And which is roughly coming around what? Based upon the current IV, they would have been calculated. So whatever is the IV numbers over here, so based upon this IV, they will be arriving to the minus 1 standard deviation and plus 1 standard deviation also. Okay, so whatever I done is a rough calculation, but whatever the tool is doing is an actual calculation. So you always have an idea. So this range, price moving between this range, what is the probability? What is the probability? Maybe for the people who haven't seen normal distribution, I think today not many people haven't understood normal distribution. So maybe you can go and get normal distribution. Okay. Maybe you would have studied in high school mathematics. This is how the normal distribution curve looks like. It also called as an bell curve shaped distribution. You can see that. Maybe I'll take a better picture. Yeah, so maybe this looks pretty better. So this is the zone. Actually, it is 68.2%, but here they had given some rough idea like 34. That is between minus 1 standard deviation to plus 1 standard deviation. It falls to 68%. That is the exact same thing the Opstra tool is also attempting to explain here. So that means what? Nifty could fluctuate on an average between in this expiry. Nifty could fluctuate between these two ranges. And it is calculated for the expiry, right? All right. So let's move a little bit faster. Here are some of the recent places where the IVs went crazy: demonetization, Brexit, central elections, both 2014 and 19. Trade war tensions, COVID crisis, Russian-Ukraine war, right? So not everything is a crisis. Most of them are crisis, of course, but some of them are not crisis. Like central elections, they're not crisis. But whenever the major events are nearing and people have huge anticipation, it doesn't matter whether it is greed or fear, the volatility tend to increase. And current Nifty and Bank Nifty IV levels, if I'm looking into that, Nifty is at like 20.47. That is a current IV. As I said, IVs will be mostly based upon the if the market is nearing the expiry, then generally they take the IVs, call IV and put IV. They take an average out of it, and then they make an total average IV out of it. That is what they try to do here. And that is what they're trying to do with the Bank Nifty also. That they take the call IV and put IV and they take an average out of it. So typically you can see that Nifty is 20, that means Bank Nifty is 24. That means Bank Nifty is more volatile than Nifty. That is what it means. And different stocks will have different IVs. So for example, here are the list of high IV stocks. You can see that IV number at times can reach beyond 100% also. Right now, none of them are reaching more than 100%, but you can see that 70%, 88%. I think Rbl Bank also should be there. So maybe the IVs are at the highest level. Big numbers are here. Big IV numbers alone doesn't matter. sometimes IVs could be getting extreme. So how it is getting into extreme, sometimes the IVs can reach as high as like even 300% also. Like, for example, let's say like this is a IV of Nifty and here is an IV of Idea. Look at the IVs of Idea. What I'm seeing is like this is a place where it went like 350%. Now, what does that mean? So this IV number, right, 350%, it's like 350%. 350%. Now, what does that mean? That means there is a total uncertainty in that particular stock. Total uncertainty. When I say total uncertainty, even the stock can go bankrupt also. That is the kind of scenario it is. Means if you are investing in that particular stock, there's a high chance that maybe the stock might go for a bankruptcy also. If something is not maturing, if the companies are likely to nobody's caring about the fundamentals of the company, it could go to zero also. Stock price can get even delisted from the exchange also. But however, some reasons, this will become more of an operator kind of stocks. If at all stock is improving, even on like 4 rupees stock can go to 8 rupees, 12 rupees kind of thing. That is easily possible because it will be mostly a traded stock. Mostly, it's not an investing stock. Mostly, it becomes a tradable stock because this kind of uncertainty, none of the institutional investors will bet on. Right, so mostly this will be a tradable stock. We'll be finding it like 4 rupees can go to 8 rupees or even 12 rupees, even 16 rupees also, because annually they're expecting a 350% movement. If it is positively working out, it could be like the stock could double or triple also. And right now we don't have that kind of uncertainty, right? Sometimes when market goes crazy, sometime back, like one of the airways which was about to get bankrupt, like that has been gone crazily big numbers, like 140%, 240%, something like that. So some companies, when they are reaching the uncertainty, sometimes companies goes for very, very tough situation, very, very bad situations. Like once, couple of companies like Satyam went bankrupt, like that. So during that time, the IV's numbers will be going extraordinarily crazy. People will have very fearful expectations. Stock price will be like trading at 4 rupees, 5 rupees, 6 rupees. And those kind of stocks, if it is not, the companies are not getting bankrupt, that 6 rupees stock can go to 12 rupees or 18 rupees kind of tough stuff. But more or less, those kind of stocks, long-term investors will be going away from the system. Sometime back, even Yes Bank, maybe I'll show you Yes Bank, how it went crazy when there was a huge crisis was there on Yes Bank. I'll go to the options and then I'll go to the IV charts. Unfortunately, I think Yes Bank is no more in the F&O space, so we can't get the charts. But I'm sure IV charts went so crazily extreme back then in 2019. Anyways, and then we have India VIX. India VIX is also another factor, but the implied volatility, how it looks into the future, India VIX is also looks into the future. The only difference is IVs are calculated based upon the Black-Scholes model, whereas India VIX is also future volatility. It is calculated based on the out-of-the-money options, out-of-the-money Nifty options only. Okay, so India VIX is calculated only for Nifty index. So this index itself based on the calculation of some complex calculation again. Let's not go too detailed into that. But here also it is calculated based upon the bid and ask price of out-of-the-money options, current month and next month contract. So from there also we can derive the expectation. If more people are having more demand for out-of-money options, means if the out-of-money options, people are buying more, generally people buy more out-of-money options when there is a total uncertainty. Like when there is a crisis is there are times people buying 100 points, 1,000 points out of money, 500 points out of money. Now you know that if you're going to buy 500 points out of money weekly, you're going to go bankrupt because Weekly itself, Nifty is fluctuating only 500 points only. Very rarely it's going 600, 700 points. Very, very rarely, super rarely. That too only if there is a strong news-based impact is there. Only when there is a news-based impact is there, weekly Nifty is going beyond 700 points, 800 points, something like that. So back then, every day was an uncertainty. So people are left, right, they've been buying 500 points call option, 1000 points call option, 1500 point call option. That is the kind of craziness that we had seen back then. And markets also relatively taken a big impact on that as well. So that place, yes, buying an out of the money option was a successful methodology. But in a normal situation, normal calm situation, if you're going to buy out of the money options, there's a very high possible chance that one could end up losing more money on out of money options, particularly in this kind of relatively calm markets. You can buy, but mostly if you're closing it intraday, it's well and good. If in case, if you are buying out of the money option and you want to carry forward for next 1 or 2, 3 days, then one have to be really lucky. You cannot make a career out of it by buying out of money options, right? So maybe one have to think different, or one have to strategize in a completely different way if you are trading options. Can option strategy be automated in AMI broker? Of course, yes. It's we had already done such kind of automations. That's a question from Tarun Kumar. Obviously, it can be automated. All right. And of course, you have to check it out, our algo platform called Algo Mojo, where we send a trade automation for options using TradingView, using AMI broker, and various other tools as well. Signals can come in futures, and order can get punched in options. That's totally possible. All right. So another one is the historical volatility. So historical volatility also, it calculates one standard deviation measure, like how much the stock could move over a period of time. And generally, it is mostly in annualized form only. So it's easy to look into the historical volatility. You can go and use tools like, there are a lot of free tools there to calculate historical volatility. One of the good ways, like you can go and use, let's say this is Nifty. I'll go to the Nifty chart. I'll go to indicators, and I'll go and type historical volatility. Historical volatility here. I'll go to the technicals. I go and apply it in TradingView. So, like currently 25.95 is the current historical volatility. That means last 1 year, Nifty had on an average fluctuated plus or minus 25 points. 25%, plus or minus 25%. So that is a one standard deviation. Plus or minus one standard deviation range is like 25%. Okay. So 25 is the historical volatility. What is IV here? IV is like this is 10 period. This is for last 10 days of historical IVs. Historical volatility. In terms of percentage terms, this is not for monthly time frame. This is for annualized terms. This is in an annualized term, like how implied volatility 20% is in annualized terms. If I want to get into like last 4 days, then I have to do what? A simple formula. Again, underlying spot price into historical volatility into square root of days to expiry divided by 365. Something like that is what I have to do that to calculate for the next 4 trading days, what could be the volatility. So this is like here we are anticipating what, if 20% is the monthly volatility, next 4 days, what we can expect. What is the range that we can expect? This is a kind of an estimation for the future volatility. So this is like for 20% annualized. Whereas the same thing in historical volatility, what I'm seeing is a almost 26 is the percentage that I've been seeing, means slightly higher expectations. Compared to the current volatility, compared to the expected volatility, current volatility is very, very high. That means markets are doing more volatile than the estimated one. So you can go to implied volatility. From here, you can go to Nifty. From here, you can go to implied volatility, which is a normalized one. You can go and see the last 30 days of volatility and last 10 days of volatility. You can go and see those levels historically. Historically, you can go and plot and you can see that as well. Let's say this is like implied volatility and historical volatility. You can go and plot and check it out how last 1 year you can see. Sometimes you can see that historical volatility is above implied volatility. Sometimes implied volatility is below the historical volatility. Right now, if you could see, historical volatility is above the implied volatility. That means what? Fear is less in the expected fear is less, but in reality, more fearfulness is getting reflected. That's what it means. That's why historical volatility, or that means current volatility, is more than the expected volatility. All right. So it always revolves around that, both historical volatility and implied volatility. More or less, it revolves around that levels. So which is more important, historical volatility or implied volatility? Historical volatility, you'll get a current estimate. What is the ongoing volatility? Whether are we in a currently high volatile markets or low volatile markets? Why we need to focus on implied volatility is whether option prices are cheaper or costlier. If it is costlier, what strategy I have to follow? If it is cheaper, maybe I have to follow a different strategy. Implied volatility is a measure about how bigger the premium is. Tomorrow, if the implied volatility increases, what will happen? Option premium also increases. All of a sudden, because if there's a fear is increasing in the markets or greed is increasing in the markets, option premium also tend to increase. So Yashwant is asking about, like, is terminals is different from web portals for trading? What are the advantages of terminals over web portals? I think he's asking, and Yashwant is asking about the EXE terminals and web-based platform for trading. I don't find any difference over here. Web-based platforms will give you comfortness. Probably you can access from anywhere, right? So nowadays, many traders, they started moving towards mobile and web-based trading terminals. In fact, I haven't installed any EXE terminals in the last 2 years or so. Earlier, I was using only EXE terminals, but now modern technology is very well built in such a way, like even web-based trading terminal is more than capable of transmitting orders. Maybe in a day, if you're going to punch 4 or 5 orders, then for you, web-based terminal is more than enough. Even web-based or mobile terminal itself more than enough. But in a day, if you're going to punch maybe something like crazily 100 orders, 200 orders in a day, then maybe relying upon a slightly faster terminal, like something like EXE-based terminal for operation purpose, it's going to be easy for you, right? So that way, it's good enough to use terminals. If the more frequent the trader you are, it's good to stick with terminals. But infrequent orders, in a month, I'm going to place only 20 orders in a month. Then you can manage with the mobile itself, mobile or web-based, right? So that will be more of a comfortness. Terminals will give you like an Iron Man kind of look, but ideally it is not. It doesn't matter which terminal you're trading, right? It's going to be mostly it's faster only. The interface is going to be the same. Anyways, coming back to the topic. So we discussed various things about implied volatility and also historical volatility as well. So during the crisis time, you can see that crisis period implied volatility was only at 87, 90 was the peak. But historical volatility was going like how much? 120%. That means crazy anticipation was there, but even more crazy realities also was there. So reality was like, expectation is like 90% fluctuation. But reality, market had done even like 100, 120% fluctuations. So it means what? Market had fluctuated more than the fear. So that's a reality, right? Right now, also the market is doing the same thing. Right now, market is having fear, but markets are more reflecting that fear right now. That is why current historical volatility is also more than the implied volatility. Okay, so when volatility is increasing, so we say we play long volatility strategies whenever there's an increasing IV, or whenever we are anticipating a big gap up or a big gap down. You know, whenever there's a big gap up or big gap down kind of move, volatility tend to increase. And whenever there is a big anticipation from the events, more than a gap up, gap down will have long volatility. Sometimes even a gap up could reduce the volatility. IV could tell sometimes reduce also. But whenever there's a big anticipation from the events, volatility tend to increase. And whenever we are anticipating a sudden big price action during expiry, then also one can play long volatility strategies. And short volatility, typically we'll be expecting whenever we are expecting a slowdown in IVs. When IV always goes like a cycle, right? So in a fearful market IVs rises, and then once the event is over, once the uncertainty is over, the IV started cooling off. Means volatility in the market's cooling off. Again, it'll be like trading sideways, and then event happens, expectation rises, and it cools off again. Maybe sometimes it might take us, sometimes it might take a very slow approach towards cooling. Sometimes it might cool down very slowly. It will cool down. It will take a longer period to cool down. For example, the one which happened during the COVID crisis. When the COVID crisis, when IVs went up crazily up, you can see that it took more than it reaches a peak around March month itself. But then to slow down and come back to the normal, it took almost some 6 months to get back to normal. 6 months to get back to normal scenario, normal routine scenario. And even these are like slightly bigger fluctuation only, even much cooler. It has to happen. It took more than a year to get back to the normal routine market scenario. Like during 2021 July, we had seen one of the lowest IVs. Sometimes market goes for a big crazy period. It might take a little bit of time to cool down. It instantly will not cool down. For example, here the fluctuation during this point, intraday fluctuation during the COVID crisis was like 700 to even one of the day we had seen 1,800 points of intraday fluctuation. Yeah. But once this is settled down, still we had seen fluctuation. The fluctuation got reduced. In the April month, it got reduced to something like 400 to 500 points of fluctuation in the April month. And then May month, it got even more reduced to 250 to 300, 350 points of fluctuation. And then slowly that volatility range got cooled down, and then it went like even like 150 to even 250 point of intraday fluctuation. So it is not an one day, within one day or within a couple of days, the volatility will not cool off just like that. When volatility is happening, it will happen in clusters. Suddenly, if the volatility is ramping up, that tremors will be felt like an earthquake, right? So even if it's slowing down also, sometimes it will be slowly slowing down when the impact is very, very high, super high. When the impact is moderate, very quickly they will slow down. For example, here, we had seen some small rising tensions, and then it got cooled off immediately. Where the Ukraine-Russian tension was there for 2 months, and it got very quickly got cooled off within May series and I think March series. It got cooled off. March and April series, it took 2 months to cool off again back to the same level it went. But then some other tensions are always keep on happening, but all these tensions are like what, small tensions only, as of now, not like COVID kind of crisis. Anyways, so short volatility, particularly if I am expecting a sideways price action, or I'm expecting less volatile price swings, or if I'm expecting a very big fluctuation, but still markets are likely to trade sideways or dull boring sideways, I can do short volatility strategies. So some of the short volatility strategies is what I'm going to talk about here. You can trade short volatility without hedge also, with the hedge also. Without hedge, it's going to be risky, too risky. You will be getting limited profits, but high win rates. Your win rates will be higher. However, since you are getting a higher win rate, if things are going wrong, totally wrong, let's say you're expecting 500 points or 600 point range only for this week, but markets are doing 1,000, 1,500 points, that is a place you'll be experiencing unlimited losses. You know, right? Once in a 10-year once, or once in a decade once, or once in a millennium once, such kind of crazy volatility, sometimes it happens in Nifty, Bank Nifty. Otherwise, Nifty and Bank Nifty is highly organized markets. Not only Nifty, Bank Nifty, most of the international developed markets also highly organized markets. Means just like that, you will not, for no reason, market will not crash 1,000 points. For no reason, market will not go 1,000 points in the same week itself in Nifty. Okay, So, but once in a while, when that extraordinary news event is hitting, that is where traders will experience unlimited losses, particularly short volatility traders. That is why unlimited losses. So does that unlimited losses happens all the time? If you ask me, absolutely not. So only when the news is hitting the markets. Like recently we had that Fed announcement, and then the same day, Nifty crashed. The very next day, Nifty crashed 500 points from the peak. From the day high, day low was like 500 points intraday. That is something crazy. But short straddle is something like we'll be selling at the money call option and at the money put option. So maybe I'll show you. I'll go to the Atr tool. So from here, I'll go to options and then strategy builder. From here, I'll go and at the money options, right? 15,700. So I'll select the straddle and then I'll sell the straddle. So in the selling the straddle, we'll be selling 15,700, which is the nearest strike price. Call option also, put option also, will be using the same strike price to sell. I'm going to sell it. So since selling is involved, a margin will be charged. 1,18,000 margin will be charged. And we'll be collecting the credit, net credit will be collected, will be like 158 points. I'll be collecting on one side, and 148 points I'll be collecting on another side. You know, right? It's a credit strategy. Credit strategy means option selling strategy. So we'll be collecting the credits, and thereby, since we are collecting credits, we'll be collecting credits worth 15,362 rupees. And since there is a risk is involved, so you can see that from the payoff graph, risk is there on both the sides. If suddenly market is going beyond one standard deviation move, there could be, the traders might be experiencing bigger losses. If the markets are doing 2 standard deviation moves, which market does once in every 6 months, market does 2 standard deviation moves. Sometimes the market can do even 10 standard deviation, 20 standard deviation moves also. Like kind of big market crashes that you would have seen in the past. Back in 2008, market had crashed like one of the day, like 15% crash. So that kind of extreme tensions was there. Sometimes the black swan kind of events, the market could move even intraday itself beyond the 2 standard deviation move. Now that is where the option sellers, they will lose money. Otherwise, their win rate is like 53.7. The chances of them winning is 53%. Why? If I assume that this is 68%, this is 68%. So a straddle player is gonna win only if the market is trying to rotate in this range. So the outer one, the plus and minus 1 standard deviation range is going to be how much? 58% probability. Whereas a straddle player, weekly straddle player, roughly they're going to enjoy anywhere between 52 to 56%, depends upon the highly volatile markets. The highly volatile markets, then their probability of profit slightly increases towards 56, or in a low volatile market can go as low as like 50, 51, 52 range. More or less, it will be likely to be around this range only. Most of the most of the straddle, if you want to sell the straddle, one could benefit only because of time decay only. So here the expectation is like more time is likely to decay, and market is likely to trade between a resistance. Only if you know that market is likely to trade between this range, it means you are having a strong idea that resistance is at 16,000 and the support is at 15,400. Then only one can initiate such kind of strategies. So you're expecting price to trade between 16,000 and 15,400 on both the sides. Nifty is likely to trade like this. Only in that case, one should invoke short straddle positionally and can hold it till expiry. And yes, they can get, and compared to the option buyers, they enjoy slightly higher win rates, right? But is it risky? If you ask me, yes. Once in a while, it is going to be risky, but it is not as risky as futures. Compared to futures, it is still better only. But futures will have unlimited profit, unlimited losses, whereas straddle will have slightly higher win rate, but better than futures. Losses, if losses is happening in futures and losses if it is happening in straddle, then I would say like straddle will have less losses compared to futures. Okay, but straddle will have limited winning games compared to futures. Again, that is a drawback. So there is a risk perspective, straddle is less riskier compared to futures. For example, if futures is losing 500 points, then there'll be instant 500 point losses there. if I am having straddle, if Nifty goes down by 500 points or if Nifty goes up by 500 points, then the losses will not be that big. But in futures, yes, there's the benefit is also there. 500 points, if it is happening in my favor, I'm going to get that 500 points. Whereas in straddle, if price goes either way 500 points, there is going to be a reasonable amount of losses will be there. Not a big loss, but sizable loss if market moves either way. That's a drawback. All right. So when this kind of strategies can be practiced, maybe if you're expecting a calm market situation or markets are experiencing high volatility, from the high volatility, you're expecting markets to cool off. Means once uncertainty in the market is over, you're thinking that uncertainty is over. Now volatility, huge volatility is there in the markets. Now it is expected to cool off. When you're expecting volatility to cool off, these kind of straddles or even strangles can be played. So straddle is what? Selling at the money call and at the money put. Whereas strangles, if I go to the strangles here, strangles are like selling cheaper options. It's all about like selling an out of the money call option and out of money put option. Thereby, since it's an option selling strategy, but we can get a wider expectation. You can see that you can construct up to -1 standard deviation to +1 standard deviation also. So for example, this is like 65.99, right? What I can do is like I can go and sell slightly higher premium, maybe something like 15,950, where I can get more higher premium. Nearer the strike price, more the premium, right? So, or maybe far away I have to go. So let's say 16,100. I'll go 16,100 over here. So that I'm just trying to construct with a 68. Roughly, this is 68% probability, right? Be on one side, it is like 16,100 and 15,500. So one side, it is breaking the +1 standard deviation zone, whereas -1 standard deviation zone, if I want to give it a little bit further, what I have to do is like put side also I have to adjust. So put side, I'll say like 15,300 maybe, right? So very far away strikes I'm going there, thereby collecting more and more cheaper premiums. So here one side I'm collecting 23 points, other side I'm just collecting 40 points. Now you can see I'm able to construct, I'm able to reach +1 standard deviation and -1 standard deviation. That means what? I can construct a strategy with a 73% win rate, 73% win rate, and I can make a 3% returns out of it. That means what? Nifty trading in this range is 73% odds. So that is a 73% chance, which is slightly higher, right? By any means, 73% is a very high chance. There is a 73% range that Nifty is likely to trade between 15,200 to 16,164. That is how many percentage? That is like approximately, we are betting that Nifty back and forth, it can still survive 900 points of fluctuations. 900 points of fluctuation in next 4 trading sessions. What do you think? This will be successful next week or not? I'll do one thing. I'll save the strategy. Let's observe the next part 3 next week when we are going to talk about that. We'll talk about this. If Nifty is going to fluctuate 500 points, it can fluctuate either side. It can fluctuate. Let's say from current level, Nifty is going to openly calm 15,700. It can fluctuate, go up to 500, 600 points on the upper side, or it can go down another 500, 600 points on the downside. So either way, this strategy looks safer and it has a very high probability. But if in case, as I said, a high volatility can happen when sudden news is hitting. Sometimes somewhere the news is going bad. Let's say suddenly the world war is starting, or suddenly some extraordinary fearful news. As I said, it's always going to be there. But extreme fearful news is going to hit the markets. That is where these levels could be broken. Listen carefully. These kind of levels can be broken. If there is going to be extreme negative sentiment, if it is also there, it can get broken. If there is extreme positive news also, if it is going to be there, it can be broken. But still, that possibilities are very less. Okay, either way, we'll try to construct the strategy here. I'm just going to put this into something like an custom portfolio, paper portfolio, right? So for tracking purpose, I'll say like maybe weekly straddle strategy, weekly strangle strategy, strangle strategy. Okay, I'll put in a paper portfolio. So we'll come back and track it so that we can track that particular strategy, how much money it is making or not. Is it so there is an 3.22% on the invested capital. You can see that this is also Strangle strategy. So we are selling on both the sides. We are collecting 23 points and 40 points. Total, we are collecting 64 points is what on a roughly we are collecting over here. So what does that brings? That brings on the invested capital. You are trying to make 3.22% return on that. That is the maximum ROI that one can get from this maximum deployed margin. So let me tell you who will do this. Mostly monthly income players. There are a lot of players who are having larger capital, but they are looking for, from the larger capital, they want to generate some 1% returns or 2% returns in a month or 3% returns in a month. Now, those kind of people are the one who go and deploy this kind of strategies, right? So they're not directional players. We can call them as like short volatility. Mostly they'll be trying to short the options and they will be taking some sort of hedges and they try to generate 1 or 2% returns or 3% returns out of it. Right. So yeah, sometimes if they are getting aggressive, they will go for like 5%, 10% also, but more aggressive, they are going more bigger the bets they are making in the markets. If sometimes if that accidents are going to happen, they could lose all their money in one shot. Right. But there are certain monthly income generation strategies where one can play in a very conservative manner. Even if the accidents are going to happen also, risk will be still limited risk. But here the risk are like unlimited. Unlimited risk, as I said, this kind of unlimited risk, one can feel the pain only if suddenly there is a 2 standard deviation move on either side, either plus 2 standard deviation movement or even negative 2 standard deviation movement. The short sellers, option short sellers will feel the pain only in those periods, but that chances are very, very less. You know, like out of 365 days, maybe some 5 or 10 days, such kind of movements are likely to happen. The rest of the time, markets are going to calmly, it's going to move. So most of the time they are safe, but only on the occasions of events. Events is the place where option sellers at times they get stuck. These kind of naked option sellers. But there are ways one can also protect themselves. We call it as a hedge, right? So where your profits also limited, your losses also limited, because we'll be taking a hedge. Let's say I'm playing a short straddle. I can purchase out of the money call option and put option over here. For example, let's say I'll go and take an, I'll reset here. I'll go and take a straddle, at the money straddle, 15,700 call option and put option I'm going to sell. So if I sell, what I will get? I will be getting a this V-shape, inverted V-shape zone. This is a profitability zone. If I'm going to hold till expiry, I will be able to get a maximum benefit around if the price is likely to close around 15,700 levels. So where the break-even levels is like anywhere the price is going to end between this level, the profit is more or less guaranteed. Some amount of profit is always guaranteed if the price is going to expire around these levels. However, here you can see that the risk is unlimited. Now, what I can do here is I can add a few more legs. Maybe if I buy a far away out of the money call option, something like, let's say I'm going to buy 15,000 call option. I'll go and buy 15,000 call option. Let's say I'll go and buy 15,400 call option. I'm going to buy a call option of the same expiry, same quantity, 15,000 call option. The cheaper option is what I'm going to buy it. If I'm going to buy this call option, I mean, sorry, not a call option, downside, right? So put option, it's going to be 14 rupees option. So I'll add to the position. On one side, I'm just my unlimited losses got protected. You can see that my maximum loss is limited to 20,000. Likewise, on the other side also, I can limit my unlimited losses. How? By adding a far away call option. So here we bought a put option over here, a cheaper put option I bought. Remember, for an option seller strategy, buying option is always a hedge. Okay, for an option buyer, option selling is always a hedge. So it's exactly works the opposite way. So we bought a put option so that our downside risk is limited. Now, even if the market is going to crash 20% also, my loss is risk defined over here. However, you can see that more the debit I'm adding means I'm trying to buy option, my win rate also reduces. Earlier, without that, my win rate was like 53%. Now I added put side, so my probability of profit comes to 51.64%. Now, if I add a call option also, I'm going to add a call option also, equal distance. So that means what? One of the put option that we chosen is 15,700. 700 points down, I added a downside put option. Likewise, from the 15,700 call option, 700 points up, which is like 16,400 call option, I'm going to add a equal amount of call option out of the money, cheap call option, I'm going to add at 16,400. 16,400. So it's like trading at like some 4 rupees. I'll add it. It's what we call as equal distance. So now my payoff graph will look like this. It is still straddle only, but now the losses are limited on both the sides. Limited losses on the downside also. And there is a limited losses on the upper side also. Limited losses on the upper side also. And likewise, limited profit also. Limited profit as well. But on the other side, you can also see that the win rate reduced to 50.88. Earlier, it was only a straddle where we got the maximum probability of profit, like 53% is the POP, or probability of profit. But the moment I added hedges, that is, though it is limiting the losses, one side it is limiting the losses, but another side, it is adding more debit into my system. So that is degrading my max profit, not only max profit, but also it is affecting my probability of profit is also. Because since I added more debit to the system. But still it is a net credit strategy because we are collecting more credits and we are buying less debits. So that's why it's a credit strategy. Still it is an option selling strategy, right? But it is better than that. Since the losses are limited, your margin also comes down. So look at that, how the margin comes down. Let me show you how much the margin comes down. The margin comes down to 72,000. So you don't need to have 1.18 lakhs. Earlier it was like 1.18 lakhs. Now, since my risk is limited on both the sides, my losses are limited. So exchange also asked me to pay lesser security deposit. Okay, maybe if I bring it to this one like very close or something like 15,400, I'm just getting even more tighter hedges. But my cost of premium is so high. If my cost of premium is so high, my probability of profit you can reduce even a lot. Okay, so you can see that if I'm totally bearish, even if I'm bearish, but I'm mildly bearish also, I can still play this strategy. You can see that even that suddenly there's going to be a big crash on the downside, I can limit my downside risk. I can adjust my which side based upon what I'm thinking. I still want to play the straddle, but I'm thinking that market may not fall much, but even if there is suddenly something is downside, it's going to go crazy also, I cannot lose not more than 2,698 rupees is the maximum loss per set. So that way, since you are reducing the risk on one side, your margin also comes down drastically. Once again, if you're coming down on the call side also, let's say I'm just coming down on the call side, another 400 points, I'm just coming down. So now your risk will get very much tighter, right? So your risk will be on both the sides, will be tighter risk. Your reward is also a small reward only, not a bigger one. So since you are controlling the risk on both the sides, since your risk is coming down, exchange also charges a smaller margin only. So margin requirement also will come down. That is how the new margin rules works out. Okay. So if you are an option seller or an option buyer, doesn't matter. You need to know if you are taking any hedges, what will be the estimated margin that you have to pay if you are an option seller. Like imagine maybe your margin comes down, or even if you're an option buyer, you have to take an option selling as an hedging. So in that case, what kind of margin you have to pay? More risk controlled it is, lesser the margin is what you're going to end up paying mostly. All right. So talking from that angle, butterfly is nothing but what? Short straddle, hedged with out of money call and put option. Whereas iron condor is nothing but short strangle. So what is short strangle? We already seen what is short strangle, right? Short strangle is like selling out of the money call option and out of money put option. The same short strangle, if I hedge it with slightly far out of money call option and put option, is what? It becomes an iron condor. And an iron condor will be looking something like this. Maybe I'll try to show you how to build an iron condor. Even though iron condor is there, what I'll do is I do one thing. I'll reset the thing. I'll go and sell a strangle. So strangle is where, let's say I'll go and sell 15,600 and 15,400 and 16,000 call option. Both are out of the money call option. I'm going to sell it. So we'll be able to get a wider premium if the market is likely to fluctuate between these range. Then what? Then we can get a 66% win rate. However, still the losses are unlimited. In order to reduce the unlimited losses, I'm going to add a hedge on both the sides. So let's see how to add a hedge. So I'm going to take, so one side we are buying what? I mean, one side we are selling 15,400. So I'll go even further cheaper premiums down below that, something like 15,000 put option. I'm going to sell 15,000 put option, 400 strike down. I'm going from the sold option. So I'll go to 15,000 put option, which is like cheaper premium. I'll go and add it. It's going to be a buying position, right? So short straddle are both what? Selling position. So how do I know that? Because we are having -1 over here. You could see, you could be able to see a negative -1. These are selling position. These are option selling position. And so since the option selling position is there, notice the premium. The premium charge will be something like 98,000 or 1,03,000 rupees is the premium which is charged. I mean margin. So this is the margin you have to pay to the exchange. Next day morning, you'll be receiving the 42 plus 56 rupees, roughly around 98, 99 rupees is what you'll be collecting per lot. Roughly 4,952 rupees is what you'll be collecting for one set of strangle. For that, you have to pay a margin of 1,03,000 or 1,04,000 rupees. Margin you have to pay, upfront margin you have to pay. Once the contract is closed, this margin will be released by the exchange automatically. Right. So one side, what we're going to do now, we're going to buy a hedge. So hedge will do what? It will limit your losses. So losses gets limited. So obviously margin also has to come down, right? Your 1,03,000 rupees margin now comes to 89,000 rupees. Because one side, the limit losses has been limited. Means in case of extraordinary events, in case there is any sudden news announcement is going to be there, your losses will come down. So since the losses, you're limiting your losses, exchange is giving you margin benefit to that. Means they're not charging huge margin. They're saying like, okay, let me charge lesser margin only, so that you can leverage up or something like that. You can plan your risk accordingly. Likewise, call side. You notice that call side 16,000 is what I'm having. So another 500 points higher I'm going to go. So I'm going to take 16,400 call option, which is right now trading at a very cheaper rate, 4 rupee option. I'm going to buy this. So in that case, what is going to happen? In that case, my risk is controlled on both the sides. And more or less, my win rate is also likely to come down. Earlier, it was like 66% was the win rate. Now the win rate comes down because I'm adding cheaper hedges. So cheaper debits I'm adding. Because of that, my break-evens are going to come down. If my break-evens comes down, my win rate is going to likely to reduce. That is what it is happening over here. So since I limited my losses on both the sides, exchange asked me to give only 51,446 rupees only, because exchange knows that even tomorrow, if there is going to be a crazy market activity either way, this guy is going to lose maximum of 15,000. So anyways, I'm collecting upfront 51,000. From there, I can easily take 15,000 rupees. Even if tomorrow the client is not willing to pay also, exchange is more or less safe, so that they can able to collect the money from the client upfront and they can keep it as a security deposit. Right. So, but straddle and strangle is not like that. It can lose even more beyond 1 lakh also suddenly. So that is the risk is there. So that is why exchange charges a very huge margin. All right. So probably I'll show you how the straddle will look like. Straddle will be like kind of an inverted V. Win rate will be, as I said, like 50 to 56, depends upon where the IV is. And strangle, typically you can build something like even 65 to even 70, 80% also you can construct. 90% win rate also you can construct using strangle. If the win rate is increasing, probably your max profit also keeps on reducing. That means what? You'll be collecting cheaper and cheaper premiums. if you want a super high win rates. But margin is likely to be very near to the futures, because either side there is unlimited losses is there. So you will be charged very close to the future rates, both for the straddles also and for the strangles also. Straddle is even more higher. You can see that 1,18,000, because risk is there on both the sides, so it's slightly above futures. Whereas strangle, it is less risky compared to futures, so hence very close to futures margin is what it is charged. Right now, how much? 1 lakh rupees is the average margin which is collected by the exchange, roughly. Right, so slightly above futures is what they're collecting in case of short strangle. But if you are managing your risk and you're bringing into iron counter, like hedged, this is nothing but what? Hedged strangles. So margin, it can even come down to like something like 40,000, 50,000. That's the kind of thing you can come up. And something like if you're going to go for butterfly, it is nothing but straddles, at the money call an option and put option, which you are which is counterattacked by an hedges on both the sides. So margin can come down as good as like 58 to 75,000 rupees is what depends upon what kind of strike you are using. Accordingly, the margin also comes down. Lesser the risk, more the margin benefit will be. So means you have to pay less margin. More the risk you're going to have, more the margin you have to pay to the exchange. That is how the logic works. All right. And finally, we have one more final topic called volatility skew. So what is volatility skew? Is like we look into the different option strike price will have different implied volatility. So here, if I plot an strike price in the x-axis, a different strike price in the x-axis, and implied volatility in the y-axis, you'll be seeing a curve like this. So this is the type of the curve you'll be getting, like kind of a smile. All right, this looks like a smile. That means what? Where there is a place where this point, where the IV is lower, that is where you can find nominal option prices. In the money put options and in the money call options will be having, in the money put options or out of money call options will always have an higher IVs. At the money options, approximately will be having the normal IVs. IVs will tend to increase on both the sides. So that's what then volatility skew is all about. So the implied volatility for both put and call option increased if the price is moved away from the money, which generally leads to something called a concept called volatility smile. So why this is used? It is used in determining certain strategies like jade lizard kind of strategies. For that, for some special strategies, they'll be going for a volatility skew. There are some volatility skew based strategies are there. They're not regular strategies though, but once in a while, if they are finding volatility skew in the market, sometimes the skew can be positive, skew can be negative. So based on that, traders can define, should I have to go for a jade lizard or something like some other different volatility strategy if I want to approach. Now those places volatility skew will be pretty much interesting. And measuring the volatility skew, we'll get to know that where the options are having the highest premium and where the options are having the lowest premium. Definitely, you can have a fair idea about that. Generally, if you are trading a spread, like a regular spread, if you're going to trade, or you're going to trade a spreads like jade lizard kind of things, so then you need to know which contract to sell, which one is having the high volatility. Should I have to sell on the call side? Should I have to sell on the put side so that I can make use of it? You know, that kind of analysis, if you want to go, that's slightly in the advanced part. Let's not talk about that too much into that. But at the initial level, volatility skew is nothing but what? It's something which always, if I try to plot the IVs against the strike price, I will be getting a smile kind of approach. By looking into the graph, I can see where the volatility is lower. So lower the thing, where the cheaper the premium is going to be, right? So means it's not overcharged. The premiums are not overcharged. So you have some fair idea about that. And some strategies, mostly spread traders will be useful. For directional traders, I don't think you will get any benefit out of that. But if you are an directionless trader, if you're a spread trader, you trade spreads like credit spreads, debit spreads, maybe volatility skews could give you a right picture in determining which strike price you should sell. Should we have to try the call side or put side? Depends upon what kind of skew is persisting. So that'll be even more helpful. All right. So before closing out a session, there's a small promo over here. We are doing an option Hydra 5.0. This time we've been coming up with an complete 1 month of internship program on particularly for option traders. Right now, all the part 1, part 2, and part 3. So we've been covering in the mini certification course, and we've been starting with the advanced part. We'll be covering more and more strategies, option tweaks, and of course, there are many monthly income generation strategies and various volatility principles, and more and more options backtesting, not only option backtesting, but also options automated trading. And then spread strategies, how to play with spread strategies, how to control your risk using options, which strike price to select, and how better we can understand the volatility. Of course, definitely today you might have a solid understanding about volatility, but even more better how we can anticipate. And some more interesting ideas on options backtesting, and how to build a trend following system, how to trade options systematically. And on top of that, we are also having advanced concepts like adjustments, how to do adjustments, when to do adjustments, when not to do adjustments, what kind of strategies we have to play adjustments. And we're also going to use a price action technique called VSA. It's a price combined with volume. This time we're going to use it out. And along with that, we're also going to have an price action trading, not the regular supply demand price action, but something very, from my experience, how I see price action. I do have some fair idea about the supply and demand, but this is like plainly looking into the price charts alone without using any indicators, how one can make use of those things, or how I've been using it. So that is what will be covered in the upcoming Option Hydra session. So if you are interested, you can kindly consider subscribing to the program. The program will be starting from 9th of July onwards, right? It will be mostly a weekend session. So if this course, whatever the mini certification course that you are attending, if you're finding it very interesting, please go and rate it in your webinars app. That will be helping us to, at least some sort of motivation I'll be getting you out. And that is the maximum I'm expecting from you, you guys. So if you really learn something new about it, or if you're able to understand some of the concepts that you're not able to understand, and if you are able to understand from this session, please go and rate it out and let me know in your comments like what you're thinking about this session or how better we can improve. All right. So I say thank you for coming by, and hope in part 3 we will be having more clarity on implied volatility, some more metrics on implied volatility, and more interesting concepts we're going to cover in the part 3 of the session. So please go and check out the agenda, and same time next week, Saturday, 7 p.m. we will be starting with the final session, the part 3 of the session. All right. Thank you.